Today's episode is brought to you by Fiscal AI, the fastest growing equity research platform on the internet. Later on, you'll hear more about Fiscal AI and, in particular, what it can do for professional investors. But for now, let's get into it. So, Max, we're going to be talking about the most important story in markets, which is the Magnificent Seven reporting not just their revenues and earnings, but the scale of their capital expenditures is just enormous. And that is really what was driving markets higher as we sit here at all time highs. But, Max, before we get to that at the 15, 20-minute mark, we want to talk about credit because, Max, there were some credit cockroaches we saw earlier in the fall in October that have receded from the headlines. First Brands, most notable. There seems to be another one, Max, that isn't causing as much consternation, but seems to be pretty big in scale. So there's basically a fake company, a telecom company called Broadcom Telecom and Bridge Voice that has been accused of fabricating accounts receivable in a fraud that the collateral agent's lawyers have called breathtaking in scope. And the funds that are invested in this include BNP Paribas, French bank, very large French bank, as well as BlackRock through its investment fund, HPS Partners, the private credit fund that it acquired quite recently. And HPS, owned by BlackRock, apparently, according to Bloomberg, increased the size of its debt investment to about $430 million, including leverage. So basically, there's in the asset-based finance world or loans that are collateralized by assets, particularly in the non-real estate sector. So in the case of First Brands, automobiles and automobile parts. In the case of this, it's telecom equipment. It seems like there's some mischief, to put it mildly. And BNP in its earnings call earlier specifically referred to it as a fraud. And the exact quote is, "This is to be considered a fraud case and has nothing to do with the private credit environment." So again, we have more lenders saying, "Yes, this is an isolated incident. Yes, we lost 50 million. Yes, we lost 100 million here. Boom, boom, boom." But it is isolated. It is not representative of private credit in general. So it's just another story that caught my attention, Max. And although BlackRock is down modestly as we reported today, it does not appear to have reverberated throughout the credit markets as sharply as First Brands did.
I think the first one that popped onto people's radars was Tricolor, which was obviously the lender to the undocumented immigrants, perhaps like the lowest credit quality you could have out there. First Brands was essentially a fraud as well. I don't think people were using the F word in this way, which is very interesting because fraud in the legal sense has a very specific definition. And so if you accuse somebody of fraud, like, you better be certain that they qualify for that specific thing. It's not that the activity or the behavior couldn't be fraudulent in the broader sense of the term, but in the legal sense, it has a very specific definition. So for their teams to come out and use the F word is a big deal.
Absolutely, and the entrepreneur behind that, the Broadcom Telecom and Bridge Voice is Bankim Brahmbot, and the loss for BNP is 190 million euros or 220 million US dollars, which for BNP is a little bit bigger than it might be for a JP Morgan, so to speak. So definitely not a nothing burger. Like I think Nomura lost $7 million in First Brands. That can consider that a nothing burger. But these are starting to get like bigger and bigger numbers. I will say, Max, and I'm not going to claim to have read it in its entirety, but First Brands in the bankruptcy case, there's a lot of activity. So just yesterday, there was a filing that was over 400 pages long. It was one of over 10 documents that was filed just in the one day yesterday. So the bankruptcy lawyers are earning their fees, and I'm sure the fees will be immense. And Max, they went as far as you can go without saying fraud. They characterized First Brand's activity and particularly a holdco or an entity within First Brands called Carnaby and various Carnaby things as a flagrant violation of LLC agreements, and they accused them of intentional misrepresentation of indebtedness, misappropriation of cash collateral, and false borrowing-based certification. So basically, accusing them of extreme skullduggery and financial mischief and dishonesty. although I don't know if the actual F word was invoked. Max, interestingly, on the private credit, is this a private credit issue? A lot of private credit executives, particularly CEO of Blue Owl, said this is not a private credit issue. Actually, the loans hit were within the syndicated loan market, and I'm gonna take his word for him that that is was technically correct, but just going through this, 400-page accusation and basically legal paper, like, there's a it's the line is very, very blurry, and actually, one of the holdcos, um, is literally called the name of the company is called Viceroy Private Capital, so it's sounds a lot like private credit, and also these are asset-backed facilities. So this space is very blurry, and maybe 10 or 20 years ago, you could draw neat little lines between the syndicated loan market and the regular loan market, and then the private credit market. Private credit people were doing $4 million deals, and the broadly syndicated with JP Morgan, all these things were doing $900 million deals. That line has blurred, and I'm not sure that I can, with as much confidence as the Blue Owl CEO, say this is not a private credit issue.
Yeah, it does feel rather semantic, right? Like, if they're going after the same types of deals and one just happens to be won by a syndicate of banks and one happens to be won by a private credit firm or a syndicate of private credit firms in many cases, but it's not called syndicated lending because that has a very specific definition related to banks. It does seem to be a bit semantic in nature, and it begs the question. I think I said this in our last conversation. Like, doth he protest too much?
Absolutely, Max. And I'll remind our viewers that the private credit deals are typically riskier in nature than the syndicated deals in terms of who the borrower is. Now, credit people will say, and they're correct about this, that, oh, well, we have much stronger covenants and we have really smart people doing the deals. So our documentation is so tight that even if we lend to a slightly riskier borrower, we have much higher recovery rates, and we have much higher ability to actually control the assets. Whereas these syndicated loan deals, yes, they were to high quality companies like Burger King, but they had almost no protections, and that's the rise of the so-called Cov Light deals. A lot of journalists have written about this. Tracy Alloway, for example, but I actually was talking to a pretty large hedge fund to be honest, and they brought up the attention brought to my attention that these the very the covenant light nature of the syndicated loan market has actually maybe accidentally encouraged this huge private credit boom because it's allowed private credit to refinance these deals and jump ahead in line of the Cov Light people. So that has led to a huge refinancing boom that I think is why the credit markets have been so hungry and the appetite for deals has been so high. Um, I'd also note that, like, the private credit argument of, "Oh, well, we have much stronger documentation." It's like, yeah, that's true, but would you rather have a, covenant light loan to Burger King or a super tight documentation loan to, a laundromat, roll up that is extremely indebted and is a much riskier company than Burger King?
I don't really know. I mean, I guess it would depend on like the assets backing it, right? Like, is it asset backed? How strong are the covenants? But these are the types of things like when we get into credit, when you're looking like on a deal by deal basis, that um, I just don't. I don't have the expertise to tell you which one is better. And oftentimes you don't really know until after the fact. So it's interesting. There is a guy who I was interacting with on Twitter over the past month, and he is very biased, but his handle makes it clear that he is biased. He works in PR for private credit. So needless to say, he is pretty clear about what his bias is, and I think his handle is PR private credit guy. But
Not
we
Josh Clarkson, is it, Josh?
It is Josh, yeah.
Oh, yeah, yeah, cool, 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 nice.
He mentioned that Ares reported this week, and the private credit bears are in shambles because NAVs are going up. So there is a bit of narrative violation with the results that have come out.
Number 1, Max, I know who you're talking about, and I love that guy. The first time I met him, it was at an event, and, uh, people referred to him as the Jim Cramer of private credit, and, he's just an absolute dynamo, got a lot of great clients, and I think he's right about that. The sell-off in business development corps, seems to be a bit overstated. those business development corps, a lot of their borrowing is term borrowing, not in the short-term refinancing market. And I think he's been right. And also, I mean, so much money has been raised in private credit that, I mean, even if the assets were kind of bad, there's so much money to raise that there's always going to be a refinancing. I shouldn't say always a refinancing, but a lot of potentially bad deals like can be optically look good and have look good because so much money has been raised. And actually, Max, I did not look at the alternative asset managers results in detail, but I do know uh, Carlyle, alternative giant asset management leader in private equity. I know I saw on Bloomberg that their AUM in private equity declined by 3%, which is quite typical for private equity, but their private credit AUM as well as secondary AUM uh, went up a lot. So that is the area of growth within alternative asset management is private credit and increasingly secondaries. And private equity is kind of not a thing of the past, but it is not a growth area for these alternative asset managers. Max, anything else before we get into these Mag 7 earnings?
No, let's look at those companies that you did dive into. I've been, watching you all morning going into it, so excited to see what you've uncovered.
Yeah. So Max, the earnings were good. I'm not going to talk about the revenues and the earnings, but people can find that themselves. But just Microsoft's quarterly revenue growth year over year was 18%. For Amazon, it was 13%. Alphabet, it was 16%, and Meta was 26%. So these are strong numbers, the types of numbers we're used to seeing from these companies. And I'll just say, everyone's a lot of people say, "Oh my God, Magnificent Seven is so overvalued. You've got to invest in this company that's growing its earnings at 4%." Like a company that grows its earnings at between 13% to 26% deserves a higher multiple than a company that is not growing at all or growing at a 4%, your cracker company or whatever. Okay, but Max, let's get into what really matters, which is their capital expenditures. So these companies have spent an enormous amount of money on capital expenditures, mostly related to artificial intelligence development and data centers. So they're buying the chips, which is property, plant, and equipment, and then they're also buying the data centers or getting involved in the data centers in various ways. So there's actually there's ways that they can do capex by basically increasing their finance lease liabilities. Microsoft is a big user of that. But Max, I'll just give you the stated numbers. So Meta quarterly capital expenditure was 19.4 billion, up 111% year over year. Microsoft's $35 billion, up 75% year over year. Google's $24 billion, up 81% year over year. Amazon, 34 billion, up 61% year over year. So you're seeing, Max, that these four companies combined in a quarter spent well over $100 billion in capital expenditures. That's close to $500 billion annualized. So these are really big numbers when it comes to GDP. And again, this is the theme we've talked about of GDP can appear quite high. The economy, as experienced by most people in terms of their job, not related to AI, data center, their consumption, not related to AI or data centers, can be actually quite weak. But these numbers are so big that GDP looks very, very strong. Um, I think, Max, that this has fueled the huge amount of spending by these companies has fueled speculation and bearishness about these companies, saying these companies are wasting money, they're incinerating cash, and their return on the investment of this capital expenditure is going to be quite low. And in particular, I'll shout out Jim Chanos, who's made this argument probably the most articulately and ably of anyone I've seen in public, is that the weighted average life for these investments is too long. So, Microsoft or Meta will buy a chip from Nvidia. Let's be honest, Nvidia or AMD or maybe someone else, but probably Nvidia, and they will say the weighted average life for that is 5 years. So they'll take a 20% depreciation charge in year one, 20% in year two, 20% in year three. Jim Chanos' point is, and the bear argument is, if AI is so revolutionary and the increased throughput and efficiency of chips is so high that in 3 years these chips that Microsoft is the cutting edge chips that Microsoft is buying now are going to be obsolete. So actually, you should take a 3-year life or a 2-year life. So your depreciation charge should be much higher. And I think that is a really elegant and smart argument that could be true. Where I find fault with the bearish argument and have as well is just in the results of the actual revenue. So I already said the very high revenue growth of those businesses, but let's get into the weeds one. So Max, for example, let's take Microsoft and their cloud earnings were their cloud revenues were up 26% year over year. Azure was up a lot more than that. Their intelligent cloud was up a lot more than that. And Max, their commercial remaining performance obligations, which is basically what they owe to customers. So when you book a deal, you owe that. So it's a good sign that this goes up. Was up 51% year over year. So those are bookings that probably will be realized over the coming quarters and years. And they reported that actual bookings was up 110% year over year. That came from the CFO on the call. You see it in the revenues now, and also future revenues is looking very rosy too because of this huge surge in remaining performance obligations and in bookings. Now, I will say a lot of bears say, well, that's not real revenue and that can be faked and stuff. And I'm sure that happened in the .com area. But I'm going to give Microsoft the benefit of the doubt that most of that is going to be resulted in real revenue, and that's just a really big deal, Max. So the growth is there. Google Cloud had really solid growth as well. Amazon Web Services, their cloud growth was actually by far the most anemic and weakest. But I guess people had expected so little of them that the stocks rallied like crazy on the what was it, up 19%, even though uh, Microsoft and Google Cloud were up way more. I should say that Microsoft and Google, particularly Google, their clouds are smaller, so they have a lot. It's are small, it's a lot easier to grow. So want to be fair there. I hope you're enjoying today's episode. For many investors, financial data from Bloomberg, Refinitiv, Capital IQ, or FactSet is one of their biggest research expenses, with individual seats costing upwards of $20,000 a year. Despite sky high prices, these platforms have been dominant in the financial data industry. That's because many of the cheaper alternatives don't actually own their data. Instead, these cheaper alternatives are licensing from these big data providers with terms that forbid them from allowing you the ability to download it. For professional investors, downloading and working with data in Excel is a must have, and this is a major reason that the proverbial Bloomberg killer has been so elusive. All of that is changing with Fiscal AI's new enterprise tier. At less than $2,500 per year, Fiscal AI provides much of the same stock market data at 1/10 the cost of Bloomberg. And you can download it all because Fiscal actually owns their data. Instead of using huge workforces outside of the US to manually input data, Fiscal is using new AI technology to gather data directly from corporate filings, making it cheaper, faster, and more automatic than the labor intensive incumbents. That's also why Fiscal AI's data is updated within minutes of corporate earnings releases. And before you ask, yes, Fiscal does have adjusted forward estimates too. But don't just take my word for it. Start a free trial today and use the link in the description to get 15% off any paid plan, including their enterprise tier for professional investors. Let's get back to today's episode.
Yeah, I wanna play the bear for a second here and take that argument that, well, hey, a lot of this future revenue is not locked in. These contracts are not set in stone. Those people actually have to come through with the money. So these are for next year. Do we have any idea of, like, what quarter we can expect to see whether this is coming through?
So, Max, 40% of the remaining performance obligations are to be recognized over the next 12 months. That percentage has actually been declining. So I guess that means these contracts that they're signing are getting longer and longer in duration. So 40% of what I said, the RPOs, is going to be relative to the next 12 months. So that's what we know.
So we're gonna get at least some information in 2026 as to whether this capex is turning into revenue for the hyperscalers.
Right, Max. And I'll say, Google, Microsoft, and Amazon, they have huge cloud businesses, and Microsoft and Google are buying a ton of chips to meet that intelligent cloud demand. Amazon is kind of doing its own thing. I'm not going to pretend to understand it, but they're doing their own, kind of their own thing. And so they're buying chips to meet demand that they are judging is there. So of course, everything is speculative. Getting out of bed and walking across the street is always a gamble, but they are buying something to meet demand. So the CFO and the CEO on the Microsoft call said that actually, a year ago, 2 years ago, we didn't have a shortage of chips. We had a shortage of power and we had a shortage of data centers, but the chips weren't that tight. Now we have a real shortage of chips, and the demand that we're seeing from our customers is so massive that we are short. So the word short appeared on the Amazon or the Microsoft call many, many times because they said we're short, and all this money that the bears say is uh, they're spending. Microsoft is spending too much. They're saying we're not spending enough to keep up with the demand that we're seeing. And I think that the CEO and CFO of Microsoft know a lot more about that than I do. Now, Max, when it comes to Meta, okay, Meta announced huge capex, and they said that the capex that they're going to do is in the future is going to be quite high. So I haven't even talked about the future capex, but they're going to be quite high. Uh, Amazon stock rallied like a rocket ship. Google did well. Microsoft maybe not so much. But the real stock to kind of tank on earnings was Meta. And you can look at the capital expenditures of all these companies, and Meta, it doesn't even look, like they're overspending at all. But the point is that Meta is spending to make their algorithms better so that they can make more money on Instagram and Facebook. They're taking that principal risk. Like whereas Google and Microsoft are kind of buying those chips so that they can farm that compute out to their cloud computing clients. So I think that you know Microsoft and Google, at least in the market, is perceived as less risky because yes, they're doing all this capex, but it's to meet current client demand. Whereas Meta is buying it for themselves and their own products. Does that make sense?
Yeah, that does make sense, and my question would be, what are the products that they think are gonna be improved by this AI? Is it, like, serving you better ads? Is it, uh, creating content so that they don't have to pay I mean, does Meta even pay people to post or to go on their platforms? I don't think they're in the business of paying content creators, so I don't necessarily understand, um, what's being improved.
I don't either, Max. I've seen some things on Twitter about like they are characters on Facebook of there's like an alternative dad and a hippie mom. It's all AI that you can like talk to these characters. It seems I would never do it, but basically, to be cynical, like melting the brains of young people on Instagram and liquefying the brains of baby boomers on Facebook in order to extract as much money as possible. And they've been very effective at that in the past. So that they're very good at making money with advertising on Instagram and Facebook, and they have some venture capital product like projects in terms of virtual reality that don't make money.
We've been hearing about this sort of like virtual influencers, right? Where instead of a brand going and paying so and so who is a yoga instructor and they sell yoga pants or whatever through their code, use code Susie to get 10% off on yoga pants, like you could have the AI created influencer. So I was just like looking like what was the global influencer marketing spend for 2025 according to Statista is expected to be 44.18 billion in 2025. So maybe they're going after that spend and saying instead of it going to the creators who are posting on our platform, we Meta are going to create the content ourselves and actually start to take that spend.
Yeah, I have no idea, but it's they're making that bet. And from Bloomberg, you see that Meta warned in 2026 that spending would be notably larger than in 2025, and they're looking to raise money in investment grade bonds of $25 billion. So Meta's free cash flow has gone down by a considerable amount. So even though their earnings and revenues have gone up, their capex has gone up by more. So their free cash flow has declined. Their cash from operations minus their capex is that number is going negative. Meta already had, I think, raised some money in the private credit with Blue Owl. They did some data center deal. I'm not going to pretend to understand those details. Max, where I have some greater clarity is I have gone through in some detail Microsoft's capex numbers, and I'll get to that in just a moment. But I want to show you, Max, that from fiscal we can show these capital capex long-term revision trends. So what analysts are expecting for capex next year. So we can show on screen Meta's capex. Before this quarter, they were expected next year and the subsequent year to maybe spend a little over $90 billion in capex. Now it's over $100 billion. Microsoft, they before last quarter, they were expected to spend about $90 billion. Now it's $108 billion. Google, likewise, they were expected to spend $70 billion in the first quarter. Now it is all $95 billion as well. And Max, I've had many, many bad calls on this show, and I'll continue to have some. I'll range some recent ones. Number one, was totally wrong about my short term call options on wheat and precious metals. Those stocks actually collapsed as gold and silver prices declined narrowly, which I actually did say would happen. So I was totally wrong about that. The Chinese fintechs, which is an idea of mine, those are taking on the chin recently. But I will say, Max, that one area where I was right was just this that capital expenditure outlook was too small, and that these capital expenditures, these companies would spend way way more on capex than was currently being expected by analysts. And so now, Max, that Microsoft of $108 billion being expected in next year, I think it still could be too low. I'm not as confident now, but I'll explain why. So the stated number of Microsoft's capital expenditure this year was 35 billion. I actually, this is the the negative cash that you make from investing because you invested so much. A lot of that is maturation of bills and then purchase of new investments, and that can kind of mess up with the data. So by my math, listening to the CFO on the call, I'm going to call it the real capex number is $30.5 billion this quarter. So slightly less, actually, 19.4 on property, plant, and equipment, which is mainly chips, and then some of that PP&E is they're buying data centers, but a lot of the data centers that they get into, they lease them out. So this actually wasn't in the cash from investing cash flow statement, but it's like later on in the financial statements, they invested $11.1 billion in finance leases, basically in terms of leasing data centers. So $30.5 billion and max in that single quarter. And on the capex guidance, the CFO said that the growth rate of capex in 2026 is going to be higher than the growth rate in 2025. And if you just think that she's referring to pure capex, pure PP&E, that increased from 2024 to 2025 from 44 billion to 64 billion, which was a growth of 45%. So if those were to grow even at the same level, she's saying it's going to be higher. But even if it was to grow only 45% next year, that would be $92 billion just on PP&E. But she said it's going to be higher. So let's be conservative and say she's only referring to a small increase. So let's say $100 on PP&E. This quarter, uh, 36% of what I refer to as the real capex number was on these finance leases, so $11.1 billion. If you take that 36 number, you get $136 billion for next year. So I think that that is kind of that's my high estimate. I don't think it's going to be much higher than 136. And I'd say maybe a low would be 100 billion for Microsoft. The median estimate is 108 billion for Microsoft. So I think it could be somewhat higher. So Max, I just think that like all of this PP&E is going to Nvidia as well as people who work with Nvidia, all the chip supply.
All I'm hearing in my head is semiconductors, 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 buy more semis, which seems crazy. I mean, we just had like SMH, SMHX, I believe, just hit new all-time highs this past week, sort of as all of this was coming out. So clearly the market is hearing the same thing that I was hearing.
All of the capital expenditure of Microsoft and all these companies, so much of it goes towards Nvidia. I mean, like half, I think around half of all PP&E expenditure this year like went to Nvidia. That was according to one blog. I don't know if it's true. And she she said that like the Microsoft CFO said the vast majority of PP&E expenditure is on chips, and this also is on the depreciation point. She agrees with Jim Chanos that it's a short term asset, maybe not as short as Jim sees, but she specifically referred to these as short lived assets. So the depreciation expense that is 100% max is I can guarantee that depreciation expense is going to surge because the depreciation expense follows capital expenditure. You have to take the hit of the losses as these assets lose their value over time. And she clearly indicates that, but she says that that's fine because the demand is there. And they say that the demand is there. And I presume that the big clients are OpenAI, which is partly owned by Microsoft. Um, Google, I'm sure there's a lot of company A buying from company B buying from company A, but The demand is there.
So that I then I guess is my big question is what is gonna happen here? Is that shortage can we even build can we make more semiconductors, or is the price for semiconductor going to go up, which in theory should hurt the profitability, the return on this CapEx?
Yeah, Max. I mean, SK Hynix, a Korean memory producer, reported earnings revenues went up a ton, indicating tightness. There's some super old computing. Seagate Technology Holdings, which is a super old company. They make really old school stuff. That stock shot up 19% on its earnings, and I think this indicates that the shortage in the AI compute supply chain is not just in the designers, namely Nvidia. Anyone says, "Oh, Nvidia is hardware." They are hardware and software, but they design the hardware. Like it's the shortage has moved from them to the actual producers, the people who design the chips, excuse me, people who make the chips, people who fabricate the chips, mainly Taiwan Semi, as well as all the memory producers, Seagate, SK Hynix, and I mean, so many other. Micron is a notable example. So I think that the supply chain is short. The supply chain is tight. It is appears to have gotten tighter over the past 3 to 6 months. And I want to give a credit to Angus Shillington from Van Eck has just absolutely nailed this, and many others as well. So, Max, I think people are saying, is this AI capex a bubble? I think I disagree with what they mean. When I hear bubble, I say it is going to collapse and asset values are going to go down 60, 70, 80, 90% in an imminent fashion. I think that this market is experiencing incredible growth in the capital expenditures. And I think it all comes down to timing. Like, I think they could be right that this is a house of cards and it collapses in 12 months, 18 months, 24 months, or longer. I think though that like it's all about timing. In the same way, people who have been calling for recession since 2022 and they're still calling on that, they, when we have a recession, which of course will happen, they will declare victory. I view that as inappropriate because it's all about timing. If you would have been in a risk off position, investors and people listening, you would have been in a risk off position for this during this huge bull market that we've had. So I think it is all about timing. So I think that I'm not saying that it's not an AI capex bubble. I'm saying that the trend line for AI capex is clearly up, and that could be a secular tailwind, and it could be a bubble. But if it's a bubble, it is not about to pop. It is fourth, fifth, maybe sixth innings. But yeah, not time to pull out the closer yet, Max. In my view, what do I know?
What if it is a bubble? Like, at what point will that become evident, or will the market say, "Okay, this spending has gone too far"? And, the answer is, like, if the cost of chips is driven up, like, so much that it's not profitable despite the demand that companies like Microsoft are seeing, it's like, "Okay, this is great. You have all this revenue coming in, but the cost to actually meet that demand is just not economic. So we can spend all this money, but we're spinning our wheels in the mud." Or you're gonna need somebody like a visionary to come out and sort of say, "Hey, we're done with this." And when you think about the CEOs of these major companies who have been able to kind of like take a stand, I mean, Zuck like literally changed the name of his company to Meta to make a big bet on that. And obviously that was, by many people, we don't talk about the metaverse at all. Like it probably a
Not a thing.
failure.
Metaverse is not a thing.
Yeah, it's not a thing. Like I think we can all agree that like that was a failure, but I mean, he is pretty all in on this right now. I would say that he maybe has the biggest ability to come out and say, like, their business is not as directly tied to this. Like, if anybody were to come out and be like, "Hey, I think it's a bubble. We're cutting back on this," it's gonna be him, and he doesn't look like he's changing anytime soon. So it's gonna have to be something that is actually in the earnings, that shows that this is non-economic, and um, that's gonna be quarters, years, perhaps, out before we have any information on that.
Right. And Max, in my analysis, I said I'm kind of uh, agree. I kind of took for as correct the assumption that if capex go ups and revenues go up and profits go up, then that will, the surge will continue because of that. I will say though, I am sympathetic much more so to the argument that on a longer term basis, the valuations of these companies, Microsoft, Google, Meta, that they could become challenged for the following reason that, as Warren Buffett said, as we all learned from Warren Buffett, a company that requires very little capital to earn a certain return is a far better company, far more stable, far safer, a much higher moat than a company that has to invest a ton of capital. So that is why, for example, Visa, which requires very very little capital, super high margins, has a higher multiple than airline companies, which constantly have to redeploy their capital into buying tons of planes and the like. And that's just a fact of life that Visa has a higher multiple than airlines companies, and it deserves a higher multiple than airlines companies. The Magnificent Seven companies, all these companies, they required so little capital to grow. They were marvelous businesses. They grew at 15, 20, 25% in some instances year over year, and they didn't have to issue a ton of debt and you know invest in a ton of things. It was like this marvelous, marvelous business. And okay, maybe a company like that deserves a multiple of 28, dare I say 30, dare I say 40.
Now
But
we're hearing about $25 billion bond offerings.
yes, but if they're borrowing and spending so much of their money on capital expenditure, it's clearly a very different proposition. And setting the fundamentals aside of what they actually do, the cash flow statements and the capital expenditure required to grow, it looks a lot more like a Boeing than Microsoft of 10 years ago. Then maybe these multiples are far less justifiable. That's what I'll say. I'm sympathetic to
Well,
that.
yeah, yeah, and that's a valuation thing, but on a moat side, like, you could say the same thing, that capital-intensive businesses, that size is a huge advantage, and the ability to have a lower cost of capital and to be able to raise this money to do that is also a business advantage. So, it cuts against them perhaps on the valuation, and the reason they've been able to justify these high valuations relative to other companies in the market, but if this is the future of the economy, who else is going to step in? Who else is gonna be able to do a $25 billion bond offering and not really have to pay that much money to invest in this kind of stuff? There aren't many other companies out there that are gonna be able to do so. So, in the same way it is a negative for the valuation, it is a positive for, if this is the future, these guys are the only people who are gonna be able to invest enough, to actually kind of own market share.
Right. And to follow up on that point, there's an argument that for capital intensive businesses, you want the holding company to be well positioned to deploy a lot of capital. For example, like railroads are famously very capital intensive, and other railroads not owned by Berkshire Hathaway, Warren Buffett, have done very well as well. But you could say that BNSF, owned by Berkshire, is has an excellent home because Berkshire just has so much money and so much insurance float that all of its other businesses just produce gobs and gobs of cash, that it's the perfect home because what it needs Berkshire has. I think the same is true for a lot of these businesses in the Magnificent Seven. Of they have so much money and they generate so much cash that who else but them is going to be able to embark upon this AI revolution. Max, I will say something about just market cycles and where we are in the cycle is YouTube algorithm so good. This morning, early in the morning, recommended to me a Michael Saylor interview from February 21st, 2000. For our folks at home, the top in the Nasdaq and maybe the S&P, I believe, was like March 10th, 2000. So it was within 20 days of the top. Michael Saylor of MicroStrategy, before Bitcoin, it was it has a software and a cloud data analytics business, and he went on Charlie Rose, great interviewer. I think he actually lives nearby to where I live. And Michael Saylor, he's a great salesman. He referred to his products and the power of software in general as elixir. So I think that can be a top signal is when people refer to AI as elixir and they use the E word, that would be the point where you think, okay, there's going to be a crescendo here, maybe a blow off top, and then this whole thing will collapse. I would say, Max, I don't think we're in the elixir phase yet in AI.
Well, we're not starting to see the companies, the downstream, the customers, the people that are coming to Microsoft. Like, the point of sort of Elixir is gonna be when we're seeing those companies have huge amounts of cost improvements, and it's kind of like, well, then who is the marginal buyer of this AI? Once it kind of flows through to the downstream customers, and you can say, "Alright, well, this business has been improved, the costs have been cut, headcount has been cut, and they've all been massively improved by AI. Where is the growth and spend going to come? You might have them as a sort of like captive client for a period of time, but how are you going to raise
Sure.
prices on them? How are you going to grow earnings once it's kind of gone through? And either every business in the sector is doing it, or every business who's not doing it has been put out of business by those who are able to be more competitive on pricing. And I don't think we're there yet. Like there have been some talks as it relates back to somewhat the economy. I know there was one topic where like, oh, maybe we'll get into that today because I know you already talked to Joseph Wang about the Fed meeting and what we're expecting in rates. But certainly there have been talks about the weakening job market and specifically like for young people and the low end. So we are starting to see commentary about is AI taking jobs from new grads and sort of the junior members of the economy. But I don't think we've really seen like a huge case study of a company that has implemented AI and it's changed like massively changed like the margin profile of the business, right? Like that is kind of I think the sort of like peak
Yeah,
idea of what I envision.
I think you're right about that in terms of broad announcements. Amazon did a significant layoff uh, earlier, before earnings, obviously, and that could be related to AI. They could have done it anyway. I think also, Max, if organizations are using AI to get more efficient and that is a success, they don't have to lay people off. They could
Yeah.
just not hire people. And if you in the jobs number, it's a net, it's the same thing. Max, final thing I'll say on this is and a lot of this comes from an analyst on Twitter called JDM Sparky, extremely smart person. So I want to give a lot of this. What I'm going to say is coming from him, and very young. Um, that a lot of the data, a lot of the moat of these cloud businesses, Amazon Web Services, Microsoft, and Google, is that they store the data there as well, not just the compute. And I think that's been why these businesses have been good businesses. They've grown, but they've also retained their customers and other software stuff as well, software companies as well. I'm not so sure, Max, about these neo cloud providers where like all they provide is compute. Example would be uh, CoreWeave. Which partly is invested in by Nvidia, and it's a tiny little speck of dust in Nvidia's like portfolio, and but they are a big buyer of Nvidia chips, and they basically are they do transformation where they buy chips and then lease them out to customers. That has also seen a huge explosion, and that is a growing business in a AI boom. If the AI boom were to falter or even reverse, like I don't think that those businesses probably going to do very well. And I'm also not sure what the long term moat is. They're really just selling compute. Do they have that same retention ability of, oh my God, I have a 300 person business or a 3,000 person business, and I'm on AWS and I'm locked in on AWS. All my data is there. If they're just using it for compute powers, it's kind of a commodity. So I don't people should not interpret that my relative construction or just recognition that this capex is so huge and was likely to continue to be huge. Don't confuse that for like a bullishness of all
It's
AI
not it's
stocks.
not a buy sell rating. You're not giving a buy sell rating on CoreWeave?
Yeah, on CoreWeave and Iron as well. Yeah, again, I don't understand this space as well, but it's just a little too speculative for me. Let's put it that way.
All right. Well, let's transition over to what happened this week with the Fed, some of the conversation you had with Joseph Wang. I mean, I think the big statement that he made in your conversation was that the Fed is actually going to have to start expanding their balance sheet. Chairman Powell in the press conference did indicate that they're definitely going to pause, but he said that they're going to replace like the MBS that rolls off with treasuries and keep the balance sheet the same size. But Joseph went so far as to say, yeah, that's going to be short lived. They're going to be expanding before you know it. What is it that he was seeing that has him, so confident that this is what's going to occur?
Max, oftentimes there's doom and gloom about what's going on in the repo market or the Federal Reserve type stuff. But I mean, it just is a reality. It's not doom and gloom. It's a reality that there is rising stress in the money markets right now. That is not extreme by any means, but that the Federal Reserve, we were in the early stages of the Federal Reserve uh, not having perfect control over interest rate markets. The federal funds market, which is the nominal rate that the Federal Reserve controls, is probably 3 or 4 basis points above where it should be, above the regular median point. I can
There's a 25 basis point band that they set, and they want it to stay within that band. So you're saying we're 3 basis points higher than the band that they have set.
No, Max, I'm not saying that. That would be extreme. I'm saying that so after with this week's rate cut of between 3.75% and 3 and 4%, normally the rate would be 3.83, like right in the middle. Now we're at 3.87, and the 99th percentile is at 3.90. That indicates a shortage of reserves. It's very minor, but it's, I mean, big enough that you can even just see it on a chart. You don't have to zoom in. And basis points are not a lot in everyday life, but in the safest market in the world, the Treasury collateralized repo market, it's not nothing, and that is why Joseph is saying the Federal Reserve is going to have to expand, and a lot of analysts are joining Joseph in the Financial Times. We had, let's see, uh, this guy from Evercore ISI expected that monthly net purchases of treasuries are going to start in Q1 of 2026 to the tune of $35 billion a month, so over $400 billion a year. Interestingly, I posted that on Twitter, and great analyst and investor, macro guy, and Andy Constant, he said, "Jack, I've been saying this for 2 years. The Fed as well. Why are you posting this as if this was news to anyone?" And I want to give Andy credit for being right about the Fed's balance sheet, and also acknowledge that he's correct. The Federal Reserve, in its annual review, has pointed to expecting to stop QT at about December, at the end of 2025, and to modestly increase its balance sheet. However, I think a lot of that was just to keep the balance sheet in line with GDP. So the balance sheet will go up, but GDP goes up, so balance sheet as a percentage of GDP stays flat. I think this type of thing is we've never had a central bank have this balance sheet be this big, or I say pre 2008. The balance sheets have never been this big. So even the topmost experts don't really know. And I will say that it is news that the Federal Reserve is going to end quantitative tightening on December 1st, and that a lot of serious analysts, Joseph Wang, other people are calling for this expansion of the balance sheet. And I also say, again, timing matters. So there have been a lot of people who said the Federal Reserve's got to end QT immediately in 2023, and they were wrong. Like, they didn't do it for 2 years later. So timing matters. I think a lot of like bank reserve and Fed watchers, in regards to the balance sheet, for many months and years, it's kind of been washing paint dry. Like, the last real business has been the last real change was the bank term funding program of 2023, of that excitement. Like, since then, it's been a story of the Federal Reserve's uh, balance sheet is shrinking, and money is being drained out of the reverse repo facility. So Fed assets are going down, but liabilities from the reverse repo facility is going down as well. So Michael Howell, for example, has pointed out that, like, that excess liquidity has been gone back into the system. So the Michael Howell way of measuring the Fed's balance sheet and liquidity is definitely far superior than the regular, oh, I'm going to look at the Fed balance sheet and then the S&P is going to do that. But things that it's kind of been like washing paint dry, Max. And this is by far the biggest thing in the Fed's balance sheet that's happened in 2 years, by far.
Yeah, so this sort of like 3 basis point level of stress, it does happen from time to time, but it's usually around like the end of a quarter, right? When
Yeah,
banks
yeah.
are moving things around. So it's very odd. I mean, we're sitting here in October, like we're 1 month into the quarter. Like, this is not a time when it's typical to see these types of stress popping up.
Absolutely, Max. If this was happening on December 30th, Max, if this was December 31st instead of October 31st, I'd say, people on Twitter would say, "Oh my God, the Fed is losing control." But I would address that, but I would, hopefully I would remind viewers that this is end of quarter and kind of normal. But for things to get unmoored in this fashion, smack in the middle of the quarter as we are, that is a sign of stress. And I think that is why the Federal Reserve is ending quantitative tightening in 1 month on December 1st.
All right, Jack. Well, I want to wrap it up here. I think we sat down at the beginning of the month and it was a lot of the same topics talking about the AI CapEx boom. but we were also talking about gold and silver, and I think we did a poll that we asked ourselves and we asked the audience about whether gold would be at a higher price at the end of the year, whether the S&P would be at the higher price at the end of the year. And I think we both agreed that gold would be higher and the S&P would be higher.
right?
See,
And I think, Max, we said that which would go up by more. I think we both said S&P, right?
yes.
So gold went up 10% up until the 20th, and then from the 20th over the past 2 weeks, it's down 8%. Brutal. But actually, since our prediction, gold is still up. Wow, I did not realize that. Okay.
Yes, and I'm looking here and I see 2.24%. So, actually, since that came out, despite gold's pullback, gold is actually beating the S&P 500 too. So, gold is in the lead, S&P
Really?
500 is catching up. Yeah, I mean, I have 2 point I mean, look, we're recording now with 20 minutes left in the trading day on Friday, October 31st,
It's very
but
close. It's very close.
it's very close, narrow, but technically gold is still in the lead. So, I wanna ask you again, Jack, to close it out. Do you still believe the S&P 500 is going to lead?
I would say yes, Max. The surge in gold prices that was just absolutely an unhinged rise in gold prices from when we did that recording to October 20th, that made me uncomfortable about gold. And then the mini crash over the past 2 weeks, that has also made me uncomfortable. I don't like it when gold and silver get too volatile. I think in silver in particular, a lot of speculation is on this somewhat of it is on the CME. And if you're a leveraged futures trader, obviously volatility is your enemy because you have to de-risk as volatility gets bigger. I had a de-risk on the futures, but in stocks, when what was it earlier in October. So I actually think that you can time like peaks with silver when volatility goes up. So I'm not in love with how gold and silver have been trading. I'll just put that out there. And meanwhile, Max, the stock market just goes up and up and up despite all of these, negative news. President Trump met with Xi about tariffs, and I don't think a ton of concessions were gained. The price of soybeans has gone up. Shout out to Korean SOYB because China is going to be buying those soybeans. But in the scheme of the entire world, like that is not a huge negotiating piece. So I don't think on China US trade things are looking amazing. And yet the stock market goes up and up. So I really just think it is this AI capex boom. And Max, I'll say if this AI capex boom is a bubble and it falters, of course I'm bearish on the S&P 500 because that's what's been going up is the boom. So if there's a bust, of course, that's not going to be good for the S&P.
Well, I actually think that there is one big event that's coming up by the end of the year, which is gonna be hugely impactful for both of these markets that I don't really have the answer to, and it's something that's related to the Fed meeting we had this week, which is what's gonna happen in December. So, a week ago, on October 24th, we had a 91% chance of a cut happening in December, with actually
Oh
a
yeah.
greater chance of more than one cut being priced in, whether it was, 50 basis points in this meeting or 50 basis points in the next. Um, and a 3.6% chance of the Fed staying at the range that we're at now after the 25 basis point cut. That probability as of now has jumped to 65% chance of a 25 basis point cut in December and a 35% chance of us staying. With gold, I mean, there's a big people talk about inflation, but it's also the divergence between inflation and interest rate policy. And so, there was certainly an argument to be made that the Fed was overweighting its stable employment mandate in its decision on interest rate policy. And as much as I know you have stated that you believe that the real driver of the gold price rally was foreign buyers, both individual but mostly central banks, um, basically converting some of their reserves to gold from dollars, and that may be true, but there is definitely a long historical relationship between sort of like real rate policy. And if it looks like the Fed is actually starting to switch back to favoring or at least giving equal weight to the inflation side of their mandate, and that comes out in December, I think that that might cause some problems for gold and arguably for stocks.
Yeah, absolute headwind for gold. Real rates have been correlated with gold historically. Interesting, huge divergence over the past 2 years of real rates actually having gone up and gold has gone up. Normally, that it would be the opposite. But yeah, I agree. The Federal Reserve. cutting interest rates is on the margin good for gold, and if the Fed doesn't cut, that could be a headwind. It's telling Max we're nearly an hour into recording, and I haven't brought up. Oh yeah, Jay Powell was hawkish on Wednesday. Normally, Max, that would be like the first thing I say, and we would talk all about the Fed. But there's just so many things going on, and as a Fed watcher who kind of has sometimes been known as someone who focuses mostly on the Fed, monetary matters, forward guidance. I have to just acknowledge that kind of my lane of the central bank is not what is driving things. And Joseph Wang was very humble when he acknowledged that Fed is not the only game in town. It's not 2022 anymore when Powell would say something hawkish and the stock market would decline 3% and just boom like that. Powell's hawkishness, I think on an intraday decline was 70, 80 basis points, like from I don't know, 2:30 to 3 o'clock or something. But I think the market ended flat on Wednesday and has been up since then. So the
I
market
mean,
can go the market can go up with Powell being hawkish. It's just that's a
here's
possibility.
some anecdata for you. I am seeing people posting that they're going as Jensen for Halloween. Nobody is going as Jerome this year.
Yes, there we go. Interest
All
Max,
right.
I saw a Bloomberg article about there is a haunted house, which I'm sure makes a bunch of money, many acres of a haunted house. Used to be a psychiatric facility or a mansion or something, but it's now a haunted house. The owner of the haunted house property, who's just making money on all these Halloween tourists, wants to turn it into a data center.
Nice, nice.
That's where
I
we
mean,
are. That's where we
Spirit
are.
Halloween slash data centers coming to a town near you. Um, well, Jack, thank you so much. It's been a lot of fun, and as always, love doing these weekly wraps with you.
I feel the same way, Max, and people should subscribe to Monetary Matters, Apple Podcasts, Spotify, and YouTube. Max, I don't like to overhype things, but next week I am interviewing by far the most impactful guest I have ever interviewed in my career. That includes, not just at Monetary Matters, for guidance at Real Vision, ever, not even close. I told Joseph Wang who it was, and Joseph Wang said, "Wow, Jack, you are not overhyping this one." So I'm going to keep it a mystery for now. But if you're listening to this and you are not a subscriber to Monetary Matters, you've got to stay in touch. And so that you don't miss this interview. I mean, I don't think you will, but it's a big deal. People are speculating: is it Stan Druckenmiller? Is it Ray Dalio? Is it Jamie Dimon? Um, I'm going to remain tight-lipped about that. Obviously, Max, you know who it is, but stay tuned. I'll just say that. Stay tuned.
All right, Jack. Until next time.
Thanks again, Max. I hope you enjoyed today's episode. Looking to learn more about Fiscal AI? Check out the link in the description to get 15% off any paid plan, including Fiscal's Enterprise tier, which is designed specifically for professional investors who need access to downloadable data. Until next time.